Has everybody got enough coffee? You might want to get some more. So I thought I would just introduce myself a little bit about my journey into finance, and actually just say that it was not my intention to do finance. When I went to university, actually like 38 years ago, I wanted to either be a forester or a teacher. And so I went to Hamilton College in upstate New York, that some of you all know about, and I was studying to be a teacher, chose education, and in my second year, they discontinued the education department, which was bad luck. So I thought, well, gosh, I need to find a major. So I decided to major in child psychology because it was the closest thing to education that I could think of at Hamilton College. And incidentally, child psychology was a perfect degree to manage investment bankers and investment managers. Anyway, I pursued my degree and was in the process of graduating, and my father suggested that I get a job. So I applied to get my master's degree, not really a job, in psychology, a master's and a doctorate degree, and I was rejected. So I then applied to the Peace Corps and was rejected. You have to understand, by the way, the Peace Corps is a volunteer organization. Kind of a stunning blow, actually, I'll just say. Anyway, then my father was really stressed, and he said, well, you ought to apply to a bank because they have training programs to train people like you. So I applied, this was in 1981, I applied to 70 banks in the United States of America to join their training program. And I was rejected by 69 of them, but did get one yes, and that's how I started my career in finance. I want to talk a little bit about why we established Generation, what Generation is, and then really, I hope, try to make the business case around sustainable investing. And so we're sort of moving away from the world of forestry and agriculture and real assets into sort of the broader asset allocation and broader investment context. Generation is now 12 years old. We manage around $12.5 billion in three strategies: a concentrated public market global equity strategy. We manage assets in what we call the Climate Solutions Fund, which is a growth equity strategy, a private equity strategy, and then we manage credit assets. So we're a direct lender of small and middle-sized businesses, many of whom are actually here in Australia. In every case, we use sustainability in two aspects. One, in terms of setting the broader context of business, and two, to analyze the quality of business and quality of management. And sustainability in the micro sense is environmental and social governance issues, and I can go into that in a little more detail if you'd like. But to be clear, we use sustainability both on a macro and a micro basis to help us make better investment decisions. In no way, shape, or form do we consider sustainability a trade-off. We do not consider it to be trading value for values, and in fact, just the opposite. We think it allows us to make better investment decisions. And there's really two fundamental reasons for it. The first is what we've observed, and I think all of us in this room have observed, is that the broader context of business is changing and has been changing. That the drivers have changed, whether it be climate change, whether it be water, whether it be migration, whether it be health, whether that be poverty. All of these factors, these broader sustainability contexts, are becoming ever more critical, ever more interrelated, and it's becoming very clear that government and civil society cannot solve these challenges. The only way we can fully solve them is if we mobilize capital to address them. And so increasingly, business needs to be, and by extension, capital markets needs to be part of the solution. And we're confident that we as people, we as voters, will insist that businesses be part of the solution. And secondly, we know that on a company-specific basis, that sustainability, environmental and social governance issues drives the long-term success of those businesses. So let me give you some examples of how we think about this. The first, just thinking about the transition to a low-carbon economy, one broad sustainability challenge. If you think about everything that you've done today, and recognize that actually in the next 5, 10, 15 years, much of what you did today will need to change. Or certainly the inputs that allowed you to do what you did today or doing today will need to change. The context of our energy infrastructure is going to be fundamentally different. And if you think about that from an investment perspective, think about that from an investment framework, you need to think differently. Or certainly you need to assess the risks potentially differently. That's what Mark Carney from the Bank of England was saying a couple of weeks ago, where he garnered both positive acclaim as well as negative comment. He wasn't trying to prescribe his points of view on climate. He was simply saying, my job as a central banker is to protect the economy from systemic risks. Climate change can be a systemic risk. We don't want that. What we want, therefore, is greater disclosure so that we can, as investors, make an assessment of what that risk is. And I, as a central banker, can determine whether there is a systemic risk or not, or take steps to protect the economy from systemic risks. That is the changing context. And those who are analyzing or thinking about their asset allocation, thinking about the way the energy infrastructure has been operating for the last 150 years, if that's your only context, you're making a mistake. And that's what we mean by the broader context of business is changing. We need to think differently. And we're not prescribing how you think, you just need to think differently about it. And then on a company-specific basis, it's clear that there are 3 dimensions of ESG that can help drive value in investment decisions. The first is risk management and reputation management. And you only need to think of one example right now. Think of Volkswagen. Volkswagen fundamentally made it a decision to mislead its consumers, mislead really all of us, the world. The stock value, their equity value is down between 40 and 50%. This company very likely could be out of business over the course of the next couple of years. It was a failure of ethics, a failure of sustainability, ultimately. You can think of what happened to BP when they dumped a lot of oil into the Gulf of Mexico. Multiple billions of dollars of penalties associated with that. Risk management, if that's all you do is use sustainability as a risk management tool, as a lens to try to understand what could go wrong, that's worth doing in and of itself. And as an investor, there's an old adage, it goes along the lines of, if you can avoid great mistakes, you will do well. And sustainability helps you avoid great mistakes as an investor. The second, and many people have talked about this, we are living in a resource-constrained world, and it's going to become increasingly resource-constrained. And therefore, looking at businesses who understand that resource constraint and are taking active steps to manage it will allow you to have a lens on what that management team, the quality of that management team, but actually oftentimes resource wastage is in fact just a cost. It's a very bad use of capital, actually. If you're using energy in a way you shouldn't do so, or if you create an employment circumstance where there isn't a great sense of culture and you have high turnover, that's a waste. And you need to avoid that if you can do. And lastly, and I know a couple of people talked about this also this morning, What we're really interested in using sustainability for is to identify companies that are using their products and services to solve sustainability challenges, thereby driving revenues, profitability, and competitive positioning. That's the real interesting types of businesses, and increasingly there are lots of examples in a very broad array of industries ranging from finance to energy-related businesses. When I left Goldman Sachs 12 years ago, my partner, and I told him I was going to set up a firm with Al Gore and we were going to focus on sustainability. They said, well, this confirms what we already knew about you. You're crazy. But after these 12 years, it's clear that the business case driving sustainability is moving a number of investors into thinking more seriously about sustainability and actually thinking of it as an integral part of how they're managing their assets. And so the last 2 points I want to make is when one thinks about sustainability and thinks about integrating it, we would recommend strongly that in fact you do integrate it. A lot of organizations will think of sustainability as sort of a separate discipline and then have an investment discipline. We have found that if in those circumstances there is a fair amount of friction and actually there's a loss of richness of data, and therefore it's far better to think of it as an integrated approach. And secondly, and maybe the most fundamental point I want to make and close with is, as we think about the business case for sustainable investing, sustainable capitalism, as it becomes more robust and clear that it drives the long-term success of business, it actually begins to pivot and change how people need to think about it from a fiduciary perspective. Oftentimes we say, well, as a fiduciary, our job is to maximize the long-term value of our portfolios, of our clients' assets, of our pensioners, if you will. But what's clear to us actually is that sustainability does drive long-term value, and therefore those who say, well, we can't consider it because we're not fulfilling our fiduciary duty, in fact are incorrect, and in fact are mistaken. Fiduciary duty implies that you should assume and analyze every aspect that's relevant to the long-term success of a company or in a portfolio or a business, and sustainability indeed is that. So I think we now have a few questions, and then more importantly, the panel.
So we do have time for questions from the audience, and there will be a panel discussion to follow. We've got one, Michael Jenkins over in the back.
Yes, great to hear this, and of course love the leadership the generation has shown us. I'm hearkening back to a time when BP, about 15 years ago, they had a new CEO that came in who was incredibly progressive on these issues. Remember, they decided they were going to be beyond petroleum and all these things. And we thought we had a great leader. And all of a sudden, he was kicked out. And my understanding was because the business was not profiting as a result of that. And I'm hearing bits and pieces of stories of similar things where great companies that we really believe in with really charismatic leaders are heroes to us in the sustainability movement. But within the finance community, they're saying they're driving the value of their companies down by doing this. I don't know if you knew that, you know the BP person I'm talking about, and do you know what was that? What was the result? Why was he fired?
Well, sadly, there was a very specific reason that Lord Brown resigned. But we know BP, or knew BP very, very well, and I know Lord Brown very well too. Ultimately, he was not able to bring the entire organization with him in his commitment to Beyond Petroleum. And that was because actually BP was the amalgamation of a number of different businesses. And the culture of BP that was in St. James Square, which is where the headquarters was, versus where the different operating subsidiaries were very, very different. Unilever, as another example, Paul Pullman is now considered to be really the number one CEO proselytizing around sustainability. He's done it differently. He has worked very hard to make sustainability an integral core part of the long-term success of Unilever. From the day he took that job, that's exactly how he's operated. And because it's integral to their business planning, it's integral to their incentive structures, it's integral to how they perceive their place in the consumer products industry, that's why they've been able to be successful. And what's also different between today, 2015, and 2000, is that consumers increasingly are demanding that we have a different approach to how we're doing business. And so that's a long way of saying Lord Brown, he's a great person. I think his management style was not as enlightened as it could have been, whereas Paul has taken a different approach, a bottoms-up approach, and that has allowed the organization, even a large organization like Unilever, to more fully embrace and integrate sustainability.
I think we had a question. Do we still have one here? Yep, just behind you with the microphone.
Do you see alternative finance taking off? And if so, in real assets, do you think it will put the investor in the driver's seat and concur to sustainability?
What was the first part of the question, though? The first?
The development of alternative finance.
Alternative finance?
And in real assets, which puts the investors in the driver's seat.
Yes. Well, I think I'm going to change your question just a little bit to say I think actually asset owners, and there are some in this room, are really the drivers and can be the drivers of change here. Ultimately, if asset owners begin to expect, in whatever asset class, real assets, forestry, real estate, global equities, private equity, hedge funds, you name it, if the asset owners are asking their managers, how do you think about the risks associated with climate? How do you think about sustainability? How do you think about license to operate? Do you have a process to integrate that into how you're making your investment decisions and you're managing your risks? They will indeed do so. And that will help us, I think, become a little more long-term in our orientation and how we think about the broader investment universe. And I think it will help us become much more responsible and sustainable. But let me just repeat once again. We use sustainability because we think it is the best practice from a business perspective. Unilever is best in class. It has done extremely well as a stock. Generations investment approach has allowed us to do really well relative to our competitors in asset management. Sustainability is not a value set. It's actually a tool to make better investment decisions.
I think John Tobin had a question just over here.
Yeah, John Tobin at Credit Suisse. You just mentioned the example of asset managers and how their approach to sustainability can change if their clients ask for it specifically. But then what do you do about the research analyst community, which we often heard referred to as the number one obstacle to progress in corporate sustainability? Do you have any thoughts about how we can nudge that forward?
Yeah, I do. And the question is, well, it may be even adding to the question. If you ask many CEOs, what they will say to you is that I never get any questions on our earnings calls about sustainability. And it frustrates us, and that's telling us is we don't think anybody cares. Now, first of all, that's a little bit of a cop-out because we know that lots of longer-term questions are being asked, and if not on earnings call, are being asked in one-on-one discussions. But the real and fundamental point is there's a difference between traders and investors. The research community, more or less, is catering towards the traders because that's the economic model that you live with, whereas the long-term investors very well may not actually be on an earnings call because it's not relevant to them necessarily, and they will be discussing their points of view or researching their points of view, their longer-term points of view in a different methodology. So I do think, unfortunately, CNBC or much of the research community, not all the research community by any stretch of imagination, but much of it is way too short-term focused. And short-term investing, when you're basically trying to compete with or trying to anticipate whether someone is going to meet their this quarter's earnings guidance or not, is really a mug's game. It's very, very difficult to win in that particular game, for sure. And so, in fact, not only is it a difficult game, but actually it's not best practice. Warren Buffett will tell you that long-term investing, any corporate finance, investment management textbook will tell you that long-term investing is best practice. And that's the orientation that we as asset owners, we as asset managers must have. That also means, by the way, incentive structures need to change. If we're going to review an asset manager or of any asset class based on a short-term outcome, guess what? They're going to respond to that review. If you review and compensate them on a longer-term outcome or with different matrices, they'll respond to that.
I think Zeb, another question? It's been answered. Rada? Yep, Robin's coming with the microphone. And then, regardless, yes, we've got a question over this side of the room. Amazing.
What? He was actually
please,
sitting
why don't
over
you
there
go
and he's
first?
moved over to...
So, David, are we going with me? Okay.
Yeah, no, please. Yeah.
David, so let's say actually that the world does actually adopt this view, the financial community does actually adopt this view around integrated sustainability research as part of a fiduciary duty. We go towards long-term investment. In that kind of scenario, actually, how do you view a company like Generation staying ahead of the curve? How do you think about strategy over the next 10, 20 years?
Well, our objective when we founded the firm was to do a great job for our clients, to create a really interesting and fun working environment for our partners and employees, and actually to try to help make sustainability mainstream. That is absolutely our highest priority, actually, in some respects. That's why we write a lot. That's why we do a lot of speaking around sustainable capitalism. And we very often have been very open source about how we think about analyzing a particular industry or a particular company. We're happy to discuss that. And it's because actually ultimately it's not the questions you ask, it's how you interpret the questions. And we've been blessed to have been at it now for 12 years. Investing is really, really hard. That's the one thing I've worked out after 35 years. It's really, really hard. And you can never rest on your laurels. You have to absolutely just keep at it. And if every single investor was working and thinking along these lines, although I doubt that will be the case, but if everybody was, you still can have an edge based on the research that you do and how you think about it, which is hopefully what we'll continue to try to develop. Luck helps too.
Bill Herditch from Fifth Estate here in Sydney. Thanks, David. I just had a comment about the trader question. Is there a problem with the length of supply chain between capital and hard assets that are being managed? If you've got lots of intermediaries, you don't really get the accountability that's required to manage in the long term. You get the profits in the short term. So the length of the supply chain between capital and assets in the sustainability space is an issue, is it not? That's my first question. Second one is a different one.
Do I get to choose which one I want?
You can. The second one is about when climate was in its ascendancy as a policy issue with Kyoto and other issues, still is, but it's not quite as high as it was. There was convenient convergence between that and peak oil, peak everything. Now, in the last year or so, we've sort of got a lot more fossil fuel coming on stream, and there's going to be this big gap between aspiration and reality. How do we solve that in the sustainability space? More regulation?
Well, we'll go to the second one first. So the real question is, will the world react to and have either regulation or policy to keep to help us keep below 2 degrees C in terms of temperature rise? And the agreement that we will likely have in Paris, I think everybody's estimate is that will not do it, and that it will be better. We'll save probably 1 degree or 2, but if we don't accelerate the commitments, we'll be at 4 degrees C in 2050 or 2060, something along those lines. I think two things. One is we probably will continue to see policy evolve, and that we will ultimately find that we have a price on carbon. I think we'll see that civil society and we as individuals will demand, even without policy, that there be change. And we now know that because of social media and other things that people move more quickly than they might have done 20 years ago. Bless you. And most importantly, the cost down curve for alternative energy is coming down far faster than anybody understands. 80% of the world will likely be grid parity with solar in the next 3 to 5 years. 80. It is a huge, huge trend and change. Now there's challenges, storage as an example, but we should not underestimate how quickly technology is changing and how quickly this will allow us to actually choose a better source. Whether we have public policy or not, it will allow us to choose a better source. And as it relates to the supply chain, I think there's a lot wrong with the investment management industry, if I'm very honest. I think our fees are too high. I don't think we're aligned with our clients very much. I think the research community is probably not providing the research that we want. There's going to be a fundamental change in that. But I also think it's quite difficult there's some, APG might be an example, there's some who can actually invest directly, but there are many, many asset owners who will need to have asset managers providing these services. And what we need to do is I think the asset owners are going to need to probably collaborate a little bit more, maybe talking to their brethren who are a bit bigger, and we need to raise the standards in the industry for sure.
Thank you.
Ladies and gentlemen, unfortunately we're out of time for questions. Please put your hands together for David Blood. Great job. Thanks very much.